Okay, so Levi Strauss just secretly built a $35 million earnings cushion into their outlook simply by refusing to model a recent Supreme Court tariff pause. Kind of respect the corporate sandbagging there.
It's actually a brilliant move. They basically baked a 30% China tariff rate straight into their full-year guide. If that Supreme Court pause holds, all that money just turns into an organic tailwind later this year.
Truly. Well, welcome to Earnings Unscripted. Today is April 7th, 2026, and we're unpacking Q1 results for Levi, ticker LEVI. It was honestly a massive quarter for them.
Right, it really was. They put up $1.74 billion in revenue. Earnings came in at 45 cents a share, which beats expectations, and is actually up from 40 cents last quarter. And, the stock reaction was pretty telling. The shares spent the actual quarter being volatile and pretty much flat, ending right around $22. But today, the regular session closed near 1970, and the stock just gapped up in after hours, rallied all the way to 2140, so essentially a 9% gain.
Okay, real quick before we go deeper, just a brief reminder that this podcast is not financial advice, just two friends sharing personal opinions. Don't sue us. But back to that stock jump. I mean, Wall Street is definitely buying this narrative. DTC, direct to consumer, is exactly 52% of their total sales now.
That's the big structural shift right there. You see a legacy apparel maker cross that 50% threshold into direct sales, and the entire margin profile starts behaving differently.
Exactly. And it's not just denim anymore. Like their CEO, Michelle Gass, was highlighting their tops business. Tops grew 13%. They're a full head-to-toe lifestyle brand now. And honestly, it's connecting with younger buyers. Harry Styles was just on his new album cover wearing vintage 501s. And management said 70% of new U.S. e-commerce orders this quarter were Gen Z and Millennials.
A 170-year-old brand pulling those demographics is pretty rare. But I do want to flag the operating side. Their adjusted EBIT margin came in at 12.5%, which is up 40 basis points quarter over quarter. It looks solid, but they're spending a lot of capital to keep that momentum going. The Super Bowl launch alone was a massive drag on that flow-through.
Right, turning San Francisco into their home turf for a month.
Yeah. And then on top of that, Harmit Singh is retiring, the CFO. After 13 years, he's stepping out.
Jeez. 13 years is a lifetime in retail finance. He basically rebuilt that whole machine for the IPO.
He did, and he left some, well, let me say that better. He left some unusual timing dynamics for whoever steps in next. There's about $30 million of European wholesale revenue that shifted early into Q1. It puffed up this quarter by roughly 2 percentage points. So Q2 is going to look mechanically weaker because of it.
Okay, yes, the classic shipment timing puzzle. All right, let's get into the details and unpack what's actually happening underneath those margins.
Well, the underlying margin story is actually a lot stronger than the 12.5% headline suggests.
You mean because of the marketing spend?
Exactly. The front-loaded Super Bowl ads take a massive bite out of this quarter. But if you strip out that media buy and some foreign exchange noise, they actually squeezed about 90 basis points of true operating leverage from the rest of the business. The core operation is getting much leaner.
Right. So this is all part of that Project Fuel initiative they've been running, streamlining the SKUs and the corporate structure.
Yes, but here is the interesting catch with Project Fuel. It is actually acting as a temporary headwind right now.
How so, if it makes them leaner?
Because of the transition. They are running parallel supply chain operations in the U.S. right now. They have legacy distribution centers open, and at the same time, they are standing up new logistics providers. So they are essentially double paying for distribution.
Oh, wow. Just bleeding efficiency out of the SG&A line.
Right. But management expects those extra U.S. distribution costs to fully taper off by Q2. And that sets up a fascinating second half of the year when you factor in that $35 million tariff cushion you mentioned earlier.
Yes. Okay, let's finally unpack that because it feels like a completely wild card. They baked in heavy tariffs, 30% for China and 20% for the rest of the world, into their official guidance.
Which is a brutally conservative assumption.
Very. But the Supreme Court and the U.S. administration paused that hike. The tariffs are just sitting at 10%. So Levi is modeling for a doomsday scenario that isn't actually happening right now.
And that is exactly what investors need to understand. If that pause sticks, Levi's organically drops $35 million in cost of goods sold. That works out to roughly a 7-cent bump to earnings per share for the rest of the year that simply isn't in their official numbers.
That's a huge margin of error they gave themselves. But what happens if the tariffs do get reinstated?
That is the best part. They don't even care. Well, they care, but the CFO basically dared the macro environment to test them. Harmit Singh said on the call, quote, "We have taken gross margins up for the year because we think we can fully offset the 19% increase in tariffs," unquote.
Offset it purely with pricing? Because that implies serious pricing power in an environment where everyone else in apparel is discounting to survive.
Mostly pricing, yes. Better channel mix, less promotional discounting, and higher average unit retail. Their flow-through is fantastic right now. They are converting top-line revenue into profit at a much higher rate.
Okay, but how are they convincing consumers to pay full price for jeans when wallets are tight? I feel like there's a limit to how much you can squeeze a premium denim buyer.
They aren't just selling them jeans anymore. The secret sauce here is expanding the total addressable market.
The tops and the dresses.
Exactly. Premium denim is roughly a $10 billion global market. They only have about 1% market share there, so there is room to grow. But general apparel is a $100 billion market. By successfully pivoting to a head-to-toe lifestyle brand, they're accessing an entirely different pool of consumer spending.
Pants to polos. It really does change the ceiling on their growth. When you look at their Blue Tab Pinnacle line growing 40%, that proves people will pay luxury prices for the Levi label on a shirt or a jacket, not just denim.
The whole ecosystem feeds itself now, and doing 52% of that through direct-to-consumer channels just locks in those higher margins. It is a very tight, highly controlled operational loop.
Yeah, it is genuinely an elegant turnaround from where they were 5 years ago. So, considering all this hidden upside and the CFO transition, where does this leave them heading into the summer quarters?
I think it leaves them playing a pretty massive expectations game, because they actually raised the full year guidance to around $1.45 for EPS, but the second quarter is going to look weird on paper.
Right, because of that $30 million European shipments shift we mentioned earlier. It artificially drags the second quarter down.
Exactly. They are guiding Q2 adjusted EBIT margins to only 8 or 9%. So if you are an investor, you kind of have to mentally blend Q1 and Q2 into a single first half. Otherwise, you might panic over pure noise.
Which is tricky when you are actively searching for a new CFO. It really feels like Harmit Singh is dropping the mic here. He built this machine over 13 years, and now he is essentially handing over the keys to a very tuned engine.
Pretty much. And he left them with a strong setup. He noted on the call that their positive trends give them confidence to raise the full-year guidance, but he made sure to add that they remain, quote, prudent about the external environment.
Classic CFO phrasing. Protect the downside. But stepping back, I think the bigger picture here is just successful corporate evolution. We see so many heritage brands bleed out because they refuse to step away from their original hero product.
Yeah, they defend the jeans business until the market totally passes them by.
Exactly, but Levi's figured out how to bottle the essence of their heritage and pour it over a much wider $100 billion apparel market. It is pretty brilliant, honestly. Maybe I need to actually go check out their dresses now.
I will probably just stick to the vintage denim, but I really cannot argue with their margins.
Okay, fair point. Well, that does it for our breakdown of Levi's first quarter. We will keep an eye out for who takes over that CFO spot next. Thanks for hanging out with us, everyone. So if you want these earnings drops to just magically appear on your feed, you might want to follow the show. And just as a quick transparency note, this is an AI-assisted project, which is honestly, the only way we can organize those giant 100-page filings so fast. We really do enjoy your feedback, so shoot us your ticker requests at earningsunscripted@datamadness.ca or grab the X link right in the show notes. Have a great week.
See you next quarter.